Hey, Renter Retires, it's Adam Schroeder here with another episode, joined as usual by Zach Lemaster, the founder and CEO of Rent to Retirement. And we are happy to be joined today by Todd Parriott. He is the owner of connectinvest.com, where you can get some short-term rental notes and get into real estate with a little bit less money than you can if you're buying a turnkey property. But Todd, thanks for joining us today.
Good morning, guys. How are you today?
We're doing well. We always like to start with the question of, how did you get into real estate? What was the first deal you ever did?
I was at UNLV and I was working in the casino industry, and Vegas had just started to explode and there was just tons of opportunity. I think we had like a population of 300,000. I think today it's about 2 million plus. And some of my friends and I in college had an opportunity to get a piece of land and be able to kind of do some zoning. And so we all got our money together. We did it. And it was a great segue into what Vegas had to offer going forward.
Vegas, baby.
Yeah. Nobody had any money, but there was 10 or 20 of us that got together. We had just enough to pull the deal off. So it was really fun.
Without even having to hit up the casinos. That's good.
No, yeah. Well, it starts in Vegas, then it spreads throughout the Midwest. All throughout the West with Utah and Denver and Arizona. They're just great cities and people love coming here.
Yeah, we didn't clarify if any of that first deal was partially funded by, gambling earnings or not. But
no, I think we were all borrowing from our parents that had sent us money to pay for college is probably what we were doing. And we all had jobs. So we were just, it was duct tape and baling wire to get that deal together. But it worked.
Oh, that's great. Well, Todd, we're super excited to have you on and talk about your company, Connect Invest, in particular because, with Rent to Retirement, we help investors build their investment portfolio with new construction or rehab properties in great markets that are leased and managed where they can come in and, acquire an asset that they have 100% control over and receive all the benefits from actually buying that property. But that does take a significant amount of capital in most cases. If someone's buying a $300,000 property, they may need a $60,000 down payment if they're putting 20% down or something like that. And so we constantly get questions from investors in that interim time where they're saving up money for that next down payment, or they're, exploring other resources with HELOCs or their retirement account or whatever the case is. It's like, what do I do with my money in the meantime until I have enough saved up to buy the next property? I mean, one benefit to having higher interest rates right now is that you can get a little bit better return on your investment, putting your money in a bank or a CD or a treasury account or something like that. Right now. However, we always want to be conscious of just being savvy investors with every dollar that we have saved. And so I think that we're really excited to talk about what Connect Invest offers, which is essentially, if I understand correctly, the ability to invest in short-term notes, being 6, 12, or 18 months to earn a high return on your investment at a lower dollar amount investment. Of course, we'd love to hear from you on specifics, but from what I understand, people can invest with as little as $500 into these short-term notes that are backed by real estate and earn a high return so they can have their money working for them while they build up that, that next down payment. Did I do a good job articulating on, what you guys offer? Or maybe it's best to just hear it from you.
No, you did a great job articulating it. As you talked about, every dollar that we have has to work as hard as possible for us. And we're always looking for that. Sometimes it's only 1% more or 1.5%. Maybe it's only 50 basis points more. But the trick is to, as you discussed with real estate, is always finding the best way to have the least amount of exposure for the best return. And through the years of doing this, we've funded billions and billions of dollars. Connect Invest is a new venture for us. And we really designed it to be able to let people that weren't of super high net worth to participate in a market where they can now get a better return they can off a CD at a bank. And it involves real estate that's backing it. So there's some good solid collateral behind it. And so we did that, and we were able to, beat what the bank was offering by 2% or more, generally, depending upon the length of it. We also were really good at, after all the years of experience, of finding ways to model it. So when people are in your program, they're trying to buy a house, they might need that money in 2 years to finally close the first deal. They might need it in 6 months, but under our structure, they can figure out the length of time that they need for that money, and they can grab it, and they can have a 6-month, a 12-month, or a 24, build up the rest of the equity they need to close the deal and go play in the other market. And so that's what we did. We put it together. We backed it with real estate, pretty similar to them owning it. They're getting the return off of it, and it's stable and it's well blended across a larger portfolio.
Yeah, I love that. And that, I mean, all the time I get the question, well, it's like, I have a few $100s, a few $1,000s sitting here in this bank account that's, may or may not be paying a okay return, at least at this point in time. Hopefully as the interest rates come down, I mean, it'll make the loans more affordable for people, but then you need to be conscious of a better ways to invest your money. This is a way that they can still participate in real estate, earn a good return in a secured fashion in a short-term manner. So if you have $500, if you have $5,000 to invest, or whatever dollar amount you want to look at, this is a way where you can, earn a good return that you really can't get just keeping your money in the bank while you're looking to grow that, your real estate portfolio. Let's talk about the logistics of it, though. Can you explain to the audience, what are short-term notes? Like, what are we actually talking about investing in, and how does that work?
Yeah, the background of the notes. First of all, the short term is really done because we blended across a large portfolio, over $600 million worth of loans that are out there. So even if you have $500, you might have, technically, it's almost like a mutual fund. You have $1 and 600 loans. Those are always rotating. The loans that we write, mostly in our industry, is we're not doing longer term loans. We're doing more of a development or things for construction for apartments and things. So they're short terms. The money continues to turn, and that allows us the opportunity to get the returns with the backed real estate, but also allows us the timing that we need to make sure that these notes can come due and pay back those investors. At the same time, always securing it with real estate.
One of the things that we've been trying to teach our investors of, it's kind of like why we created our academy and everything, is so that they can do their own, due diligence and making sure that, they're doing all of that. So so if someone, looks at your notes, what kind of due diligence do they need to be doing to make sure that they're comfortable going in? I mean, obviously y'all kind of showcase some of the numbers, but what are the big things for them to look at so that they can know, yes, I feel comfortable putting in, $5,000 into X note?
I think any real estate that's involved, you really need to understand the market that you're in and why you're even in it. I think you can continue to underwrite deeper and deeper and deeper, and that information can be provided if they want it, other than the standardized portfolio. But the first thing for us is always understanding, what markets are we in? Well, we're in Utah, we're in Colorado, Arizona, Nevada, growth markets. Why are they growth markets? What are we doing there? Also, if you look up the loans, because we post what's out there, you'll see that they're what we call a consumable boundary, or an area of pressure. And that's a critical thing. There are other companies that will do lending out there, but they get outside the ring of 5 years, 6 years. And if there's any reset to the market, what drives the value of land is the need for it or the use for it. The same thing with an apartment or anything else. So for the simple side, when you look at it, look at the location of where it is, look at that it's consumable. And the other thing is look what it's supposed to be doing. Most of it for us is in light industrial, which is easily used. It can be broken up into small companies or big companies, as well as apartments are still really needed right now with the current housing shortage, and rental things are needed. And then look at the housing markets that we're filling. And then those are just a couple of the 3 areas. We do some stuff even in some of the assisted living markets. But if you look where we go to alone, it's really where the market is needed for the next 2 or 3 years. We're not doing a 20-year play. We keep things very consistent, quick, and where the market is needed today. And so those basic things, if you look at our portfolio, is what you're going to see. If you really wanted to get down to hydrologies or electrical or whatever, what's going on in the streets, stoplights, anything you want, we have that information. But in general, what you're trying to find out is this land going to be worth something if there's even any little correction? Is this apartment complex in an area that makes sense? And those are the things that we do very well. And that's what makes us great, is if there ever is an issue, we're very capable of cleaning it up because we keep things in a really tight underwriting box.
Yeah, that's great. We know that you guys have an immaculate record, and we've had a lot of people that have invested with you, and I'm sure we'll continue. So that's really important to see from a track record perspective, and why we wanted to have you on. But also, when we talk generally about like earning a return on your investment, and especially like lending money, there's a lot of different ways that you can lend money today. And there's certain things you need to be conscious about. Some of these would be, and we've talked about this before, but of course the dollar amount that you're investing, if you're looking at something like a syndication or something like that. They could require you to be an accredited investor. They could have a $150,000 minimum, and your money's tied up for a long period of time. And unfortunately, today we're seeing a lot of those like go south, where they're doing capital calls, or people are converting money to equity and they're just not getting their capital back. But like you don't even know that potentially until 5 years later, and you don't earn any money, a return on your investment during that period of time. So I always want to remind people that look at all the factors when you're investing money, the amount of capital that you are investing. This is a great opportunity because you can start with a lower dollar amount, and if you have a good experience, then you can increase that over time. But it's not usually a high risk scenario. Like you're not investing for someone in this, or you don't have to invest a significant amount of capital. Also, liquidity is a really important concept that you need to be thinking about. Like, how long is your money tied up, and when are you going to have access to that? I think this is a really great opportunity for people to invest in short-term products at lower dollar amounts where they can earn a high return on their investment, and it's secured by real estate. So that's the other thing, is security. If you're lending money to someone, you need to be understanding what the money is backed by, right? And it's really risky, and that's the risk threshold. We've seen also where there's been some anticipated high returns out there where it's not backed by anything. It's a promissory note or something like that. Those are a bunch of red flags. So these kind of check all the boxes for someone that has a lower dollar amount that they want to invest at a decent return. It's secured, and it has the ability to be short term. Let's talk more specifically about like some of those options with what you guys have. So I believe you have a 6, 12 month, and 18 month term. Is that accurate? And what is
6, 12, and 24?
Yeah. 6, 12, and 24. Mm-hmm. Okay, so half a year, 2 years. What are average returns that you're typically seeing in those notes?
At 9.5 on the 2 year, 8.5 on the 1, and I want to say 7 on the 6. I'm pretty sure that's exactly where they sit today. We've continued to move them higher, and even though rates are going to compress, we don't see any adjustment to them. So the spread from what you're going to get from a bond or a CD from a bank to us is going to continue to increase.
Yeah, that's great to hear. So certainly higher rates of return than someone keeping their money in a bank, than a CD or bond or something like that. So that's good to hear. What about
I think one of the things that you want to touch on that's so critical to people, and they often forget, and you had mentioned it earlier, which is so important, is the time period and the lockup period. These are really highly liquidable. When you think about a 6-month CD at that rate, that's just not really out there. Participating in real estate is really a very slow game, and you have to be committed for usually a 5-year or longer period to really make something happen. What makes Connect Invest special is we found a way to let you come in and play on a short time period. And the other thing that we were able to do through a lot of work, through a lot of years, is understand that, we're not going anywhere. We're there for a long period. So try $500. It's not going to hurt you. And we're going to pay that, and you're going to get used to it. You're going to understand it. You're going to familiarize yourself with our product. And so as time goes on, I think people, they come in and out. But what they like the most is it's a very measurable period. There aren't capital calls. There's not all these weird stipulations that, we think it's 3 years, and then all of a sudden it's 7, and you can't get out. And then you got these weird tax things that happen. It's so cut and dry and simple. And that's what makes it so beautiful.
Yeah, I couldn't agree more. Is $500 a minimum amount? You had mentioned that. Is that the minimum investment?
Yeah, and we used to have a minimum of around 10, but what we did is we put it at 500. It's still a loss for us, but for us, it's more about them knowing we're not going anywhere. So for $500, you come in and you just try it. You can't. I mean, of course you can risk $500. I'm not going to say that that's not a significant amount of money, but still, it's $500 versus 10, 20, or $100,000. The idea behind Connect Invest, and for us in general, all of our work has been with the everyday person. We designed our real estate products to work with the people that are actually working out there, not these people that have inherited a bunch of money or they're uber wealthy. This was designed to let normal people participate in a market that they're normally blocked out of.
Yeah, I love that. So in a scenario where, if you're an investor that's looking to grow your portfolio and you're just not at that point, if your time horizon is, let's say, like 6 to 12 months to buy that next property, what are you doing in the meantime, right? If you have $10,000, $20,000 or whatever the case is that is sitting in a bank account, yes, you still need reserves for your portfolio, right? But, how are you earning a good return on that money to help you accomplish your goals quicker by scaling up and growing your portfolio.
Yeah, we're just such an excellent place to park at different times. Like just even if the stock market's overinflated, you come to us and you're hanging out and you're getting a 9% return or 8% return, waiting for that to do a reset. And then when it resets, liquidity is available for you to be able to move and shift into a market that's depressed. Or maybe it's the same thing with interest rates on homes, or just pushed you outside of the buying power or where it makes sense to leverage up at this particular time for a rental. And then all of a sudden, as things compress over the next year or two, they're going to be all over that because now the payments are less, the buy-ins are less, and it makes sense. So what we are really for investors, there's two types of investors that we generally get. We get the younger investors that are really learning how to keep their money working all the time when they're waiting to make bigger moves, whether it's housing or it's stock market or even certain types of junk bonds or something. But we're a good place for them to be. And that's where they can come in and out. So sometimes their accounts are, a $500 guy might go to 10,000 or 100,000. And then he might go back down to 500 or go to zero for 6 months because he's in the middle of transferring because the market shifted. And it gave him that ability to continue to earn the interest. When the market shifts, he gets to go participate where there might be a higher position of it. The middle sort of that 50 to 60-ish or 45 to 60, we have a good number of those, but they're not really playing in and out. They're just sort of buying into us and testing us out and understanding. Then when you start to get to that 60-year-old person, they're not looking necessarily to play in that higher end real estate market, but they want the security of it. They know that it's continuing to grow and they can get that consistency. So we fit, even though the product is very simple, it fits very specific needs based on an age group on what they're trying to accomplish.
Yeah, you can create predictable income, earn a good return, and depending on whatever your needs are. Like you said, it could be a supplemental retirement scenario. It could be just growing your capital for the next move while whatever you're trying to do, or if you're just trying to break into investing and participate in different things. Like we always talk about having multiple legs on the chair, right? Having multiple streams of income and not being solely reliant on things. I view this as a shorter term, decent return at a lower dollar amount. This is, I think, a good way for a lot of people to participate in this, whether you're a newer investor, like you said, more experienced investor that's just looking for additional streams of income. Well, I want to talk about the risks as well. Like where could this go wrong, or has that ever happened in the past? But I also want to ask first about what is the payout structure? Are you distributing payments monthly? Do they have to wait until their 6-month term to actually receive the interest?
No, it's paid monthly. Everything is paid monthly. It's all current pay. So once they join, 30 days later, they'll get their first interest payment and so on throughout the entire life of their investment.
So you could create monthly passive income based on whatever dollar amount, and of course that helps to. I'm assuming you could reinvest that, or do you use what?
Yeah, some people do, and some, like we were talking about, the younger guys always reinvested because they don't want the money right now. They're waiting to buy something. Usually the people that are a little bit older, they're just looking to have some passive income, whether that's to pay for their golf course membership or their, I don't know what, power bill or something. Who knows? But we get a lot of there's really two houses, and that's it. The ones that are just parking it there because they put 500 in, they get 500 back plus their interest. They don't have a variation on the capital that's put into the product. Where the people, as they get older, they really just want that income and they need it consistent every single month. So that's kind of the two split points.
What would be a potential risk factor? Has it ever happened where you haven't been able to pay someone's capital back at that call period at 6 months or whatever it is? Or what are potential risks in this scenario that people need to be aware of, even though this is secured by actual notes?
I think your situation now would the way we've have modeled it is like a 40% default rate. So the market would have to basically default off at 40% of the loans that we have in there. Our average default rate is less than 0.5% or 1% over the last decade. We've taken less than 0.0025 of any capital losses. So the risk is relatively low now. But if some catastrophe happened, like all of a sudden Las Vegas evaporated for whatever reason, sure, there would be a problem there. But we don't see that happening. And when we model for the loans, we put in a 30% correction to the model so that we can protect that the basic principle put into the loan. So The answer is that yes, things happen. Real estate abs 08 happened. It was a tough time for everybody. Some of us did really, really well with that time period, and some people got hurt really badly. It just depended upon how you worked through that market. But other than that, which was historical, especially on the real estate side, I don't find it to have the risk that a lot of other investments have. Like people that will invest in other people's credit card debt, do they want to get an 18% return? There's no collateral behind it. We're really just trying to get that 300 to 400 basis points over what the bank's willing to give you.
Now, when you're in like a high yield saving account, obviously they can, raise and lower your interest rate whenever they want and not tell you about it. So this like 2-year 9%, is that like it's gonna be 9%, or is that something where that's the floor and you've got the potential, like if there's fewer defaults than y'all have built in, where you could get 10 or 11, or is it just you're getting 9% for the next 2 years?
Right now, when they're locked in, they're locked in. The only thing we've done is move them up. We've never moved them down, and we lock them in for the period. When the market took a shift, like I said, we've been doing this for a really long time. We've done billions of this. And when the market shifted, we decided in the underwriting side of things not to jump to higher rates, but to tighten down the underwriting process. So our loans have been in that 9.5, and they'll stay in there. But as banks raise their rates, we just tightened down our underwriting to secure the portfolio, because at the time we wanted to make sure that we were protecting our investors. But at the end of the day, that's all we care about. Because what I do know, as long as those guys are getting their interest payments and they get their money back, they stay with us forever. We're a great thing, and they bring their friends. I mean, we grow at 20 to 30% a year just out of word of mouth without even marketing. So the answer to your question is the rates that are there are locked in at this point. And even as the market compresses, I don't see them going down. They're probably going to sit where they are.
Yeah, that's great to hear. The last piece that I failed to mention previously about looking at what you're investing in from a risk threshold standpoint is diversification. There's a lot of different ways that you can invest in notes. You can buy individual notes, you can buy non-performing notes. It can be very risky to invest in notes individually, but I think that in this approach, what allows you to offer the predictable returns, not have the default rate that you do, is the diversification aspect, where you're investing with a large group of people across multiple different projects. It's not like you're solely reliant on one particular note to be performing. Can you elaborate on that, the necessity out of diversification in this regard?
Yeah, and I'm going to drill down a little deeper in that, if that's okay as well.
Yeah, let's do
it. First of all, diversification is really key. Now, are we necessarily diversified and having all kinds of different products? No. We are in what we believe are some of the best growth markets that are available for different reasons. But fortunately, I don't want to offend anybody, but we don't touch California because it's just way too hard to lend down there, and it's way too hard to collect down there.
We don't touch that state either. So
yeah, it's just a crazy place, man. It's too hard to do the work, and there's a lot of people, and it's got great weather, but it's a tough place. I'm not picking on California because it's beautiful. I'm just simply saying, as far as what we do, we want to protect that investor. So we lend in places like Nevada that are creditor friendly. We lend in Arizona, the same thing, Colorado, Utah, progressive states that want to grow for their people and really give them a place to live in, as well as provide them a great place. So those are really only 4 markets, but they're some of the strongest markets in the country. And when you do that, you really get to know those markets. You get to know the people in those markets. I know they're big, but really the players of the home developers, the light industrial people, the apartment complexes, all those things that we deal with, there's still only, 10 or 20 people in those markets, because those are the ones that are doing what they do. And we really get to know them. And most of our borrowers, they're not what we call one and dones. These are people that we've had borrowing from us for decades or longer. We don't do that. We really get to know our borrowers. We really get to know our product, and we know why they work. We know how they work. And as we grow, we do slowly introduce other people, but it's a very true developed thing. But you mentioned something earlier, and I think this is what's the most critical that people really don't give credit to. When you buy notes that are unsecured, or you buy bonds, or you buy anything, at the end of the day, the value of the collateral is what's most important. But what do you do with that if there's a challenge? And that's what we're good at. We don't farm anything out. We cradle to grave everything. We underwrite the loan, we fund the loan, we service the loan. If there's a challenge with the loan, we foreclose on the loan. If the loan comes back to us, we sell it, we finish building it. We do everything. We don't just ship it off and say, oh, cool, we wrote this loan, and then we give it to some outside servicer. Everything is held with inside, and everything is in the house. And what's critical is to getting any investor their principal back is them understanding the collateral and what the collectability of that is. And then we're just good at that. That's what we're good at. We're not great marketers. We're just great operators, and we perform for people. And when you go off and you buy these weird notes and these tax liens and all this stuff, that's a great idea. And the return probably could be up to the 20s or 30s. But the amount of work that has to go in to collect something really makes that return go down. You want your money to be doing the work for you while you're not doing the work for it. And you buy those notes and you're going to be doing the work for it. So yeah, you're getting a 30% return, but you're going to put in 10, 20, hundreds of hours trying to collect the debt on that to get that margin. Is it worth the headache when you could take that effort and put it in the area that you're an expert at and let us do what we do really well and get that return? So I think people forget that time value of money as they sit there and they go, this is a great return. The same thing we talked about with these funds. They're like, I'm going to jump into this fund. And also they're getting a $100,000 capital call and they're going, oh, wait a minute, I got to go find $100,000. Now they're leveraging their house up, or they're selling something maybe they want long-term. And it's just so critical that you really need to understand what it takes to get that money back. And in our world, you don't worry about it because that's what we do if there is a problem. And the other thing is we've been through so much of it, we're good enough to underwrite because we don't really want to work that hard, to be honest. We want really good loans. We want to make sure there aren't headaches. We want to reduce that risk at the best return possible.
Yeah, very well said, Todd. Your track record obviously speaks for itself. And I think that's what it boils down to is risk versus reward, right? I mean, a lot of times people get caught up chasing higher returns. The same thing with real estate, right? Like we have a lot of people that are, oh, I could possibly get XYZ if I, rehabbed and burnt this property. And all of a sudden they're into the deal for 2.5 years and it's not done, and they have to, refinance their loans, and, and the market's changed and their holding costs and blah, blah, blah. It's like, if you just invested in like a boring deal and had a predictable return, but let all these other things compound with appreciation and rents increasing and tax benefits and leverage and all these things, it's like you would have outperformed that and had way, way less headache. So I think I just don't get the shiny object syndrome. Invest with a team that has a track record and has, like you said, it handles everything, and is very predictable. But I mean, this is, we've been investing with you guys. We have a lot of people that have great success. We loved having you on. And I mean, this is just a great way, again, just to review, invest lower dollar amounts, low as $500 in short-term notes to earn a relatively high return, much higher than you're going to earn, just keeping your money in a bank account to be able to plan your next investment. It allows you to diversify some of your investing and have it secured, by real estate. So, and it's 100% passive, right? This is truly, that's what most of our audience is looking for, is somewhat passive investment so they can do whatever they're doing, family time, operating their business, focusing on their job, other investments. I mean, it's just really an important thing to think about. So we've been extremely happy with you. We're excited to bring you to the audience. Adam, can we pop up where people can find out more about Connect Invest?
Yep, it's connectinvest.com/RTR/register. Todd, I wanted to ask one more quick question, and that is, you brought up kind of the investing in other people's, like credit card debt and all of that. And one of the things that I've seen and people have talked about whenever it comes to investing in, some notes in a group is sometimes if you can't get the funds, you just lose out on the deal. Is this something that if I invest $500 or $1,000, it's basically guaranteed to actually get the deal to fund? Or is it something that I'm going to say, I've got $2,000 for this 6-month thing, and y'all say, okay, we're going to see if we can collect the money? Like,
no, when you're in that day, it starts. There's no holdback. We have reserves that we buy more notes than we have sold yet in CDs, and they just replace that. So we always have what we call as a percentage of reserve available for our continued growth in our sales. So there isn't that risk at all at this time, or I don't ever see that really being a risk.
So they invest today, they're earning the interest paid monthly immediately.
I think it starts
right?
tomorrow. So by the time you get the paperwork done, they process it, they get everything set up. It takes 24 hours. But if you go in a day and buy it, you start on tomorrow.
What is the process for someone to invest? So they go to this, and if you're listening and you're not watching on YouTube, it's www.connectinvest.com/RTR/register. What happens then? I mean, how complicated is it, time intensive to invest with you guys?
It's really not. It takes about 15 minutes to do. You just got to put in, name, address, social security number, all the standard stuff that any investment platform would ask. And then you're going to send in whatever amount you want, $500 or whatever. That usually takes 24 hours to get into the account, and that's in it because like an ACH, you ACH the money in, or you can wire it in, it's your choice, and you're good to go the next day. You just click on if you want a 6, 12, or 24, and you're good to go.
Well, Todd, this has been great. What about taxes? Are people receiving a 1099 at the end of the year for interest, or what do they need to be aware of on the tax side?
Yeah, they'll receive their tax documents by the end of January, and it's taxed as any income you get from even a savings account. So that income is taxed, and that's out by January 31st of every year.
Yeah. Now, is this an online portal like your stock fund would be? You mentioned kind of registering and getting your money and transferring it in. Are people just going to kind of like log in and see like, oh, this is your account, this is what you've received in interest, almost like it's a Fidelity account or something like that?
It's exactly like that. You log in, you open up your account, you'll see what's in, what notes you own, and then you'll see the interest sitting in there. And if you want to pull the interest on a monthly basis, you can, or you can let it accrue. And so, yeah, it's like logging into a TD Ameritrade or anything else. Well, TD Ameritrade got bought out. I forget by who, but the point is it is.
They all got bought.
Yeah. It's an online portfolio. It's an online place to go. So,
all right. Yeah, this is great. I think, Todd, it's sometimes I look at money that I have in these different random bank accounts, and I call it sometimes dead money, because I've realized that out of all the things I'm doing, which is a little scattered, sometimes I have, maybe $10,000 here, or maybe $2,000 here or something, and it's just sitting there, right? So, I mean, this is just a reminder to myself, like, there's better things to do with that than just let it sit there and be more intentional with, some of the capital. So this is great. Thanks again for jumping on here. I know that, our investors have had great success with you guys. It's helped them accomplish their real estate goals quicker by earning a higher interest in a short period of time, and allows them to participate in other investing methods as well. So this has been great to share with us.
Yeah. Well, I appreciate the time today, and I love to help, and it's cool to get to work with you guys and continue to work with the strength and the things you've presented. We like what you're doing for your people, and we're glad that we can be part of that team. So we really appreciate everything.
Fantastic. And the website again is connectinvest.com/RTR/register. That'll also be in the show notes. Don't forget, if you have any questions you want us to ask Todd, because this is a very, we can go pretty deep if you want. If you have any questions you want us to ask him, send them on over to podcast@renttoretirement.com. That's podcast@renttoretirement.com. We can either get him to answer them for you, or we can bring him back on another episode to answer the questions that are sent in about that. So don't forget, anything you have, send it over to podcast@renttoretirement.com. And as always, you can check us out at renttoretirement.com. That's renttoretirement.com. Really appreciate all the time you spent educating yourselves today. We'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.